Welcome to my channel, Learn and Earn, to live your life on your own terms. Everyone, you're welcome to my channel, Learn and Earn Academy. And today in this video, we are going to talk about reverse repo rate. Now, what is reverse repo rate? What is the impact of reverse repo rate on Indian economy? And how RRR, reverse repo rate, impacts the monetary policy by RBI. In this video, we are going to learn and understand the same. So if you like this video, you can press the like button, subscribe to my channel, and also share this on social media. So let us start this video and understand the concept of reverse repo rate. So what is reverse repo rate? It is the rate at which central bank of a country, which is RBI in case of India, borrows money from commercial banks within the country. It is a monetary policy instrument which can be used to control the money supply in the country. And the current reverse repo rate is 6.25%. Now, what do you understand from this definition? In very simple words, RBI borrows money from commercial banks. And the rate at which RBI borrows money from commercial banks is called reverse repo rate. Now, the next question that would come to your mind is, why does RBI need money? RBI is the central bank of the country. Why do RBI require money, and that too from commercial banks? The reason is RBI controls the supply of money in the market by reverse repo rate. It's a very good example of giving incentive to the banks or asking the banks to deposit money with RBI. Now, why would a bank deposit money with RBI and not lend to the customers? Because the money which RBI will take from these commercial banks will be at a higher rate of interest. And this is the reason the commercial banks would like to give money to RBI. And this is how the money supply is controlled in the economy. I'll give you another example. Let's suppose there is huge money supply in the market and the demand of the products is very high. And RBI wants to take out the money from the market so that the demand is controlled. Now, what does RBI do? Now, in order to take or suck the money out of the market, RBI will give high reverse repo rate. Now, this will make the banks look forward to put their extra money with RBI because they'll be earning more rate of interest. And any interest which they earn from RBI is 100% secured without any fear of default. So this is the best investment which banks can do. Safely keep the money with RBI and earn high amount of interest. And the benefit to RBI is it will take out the money from the market in order to control the money supply in the market. If there is a lot of money in the market, people will buy everything. There will be huge demand and the inflation will increase. So this is a regulatory measure. This is a monetary policy instrument which RBI uses very rarely. This is one of the rarest of the steps which RBI takes to make the banks feel incentivized to put their money with RBI. So I'm sure you have understood the concept behind reverse repo rate. Reverse repo rate is the rate at which RBI borrows money from commercial banks. Simple. An increase in the reverse repo rate will decrease the money supply and vice versa. I have already explained to you. If RBI increases the reverse repo rate, banks will feel greedy to put their extra money with RBI and earn good amount of interest, which is risk free. An increase in reverse repo rate means the commercial banks will get more incentives to park their funds with RBI. This is the point. Why will a commercial bank put money with RBI than lending to the customers? Only because RBI is paying them good amount of rate of interest, thereby decreasing the supply of money in the market. So if all the commercial banks put their money with RBI and get good rate of interest, obviously the money will not be available in the market. The money will not be available in the market to lend to the people, to the customers. And this money will be safely kept with RBI and the banks will earn good rate of interest. So in the last video, I have already discussed about repo rate, CRR and SLR. Now it's a banking series which we have started, in which we want to give you the most simplest of the definitions of all the banking concepts. So let us quickly go and understand the difference between repo rate and reverse repo rate. Repo rate is the rate at which RBI lends money to banks, and reverse repo rate is the rate at which RBI borrows money from the bank. So repo rate, RBI is lending, and reverse repo rate, RBI is borrowing. In other words, repo rate is the rate at which banks borrow money from RBI, and reverse repo rate is the rate at which banks keep their money with RBI. So repo rate is always higher than reverse repo rate, and reverse repo rate is always lower than the repo rate. That is used to control inflation. Repo rate is used to control inflation, and reverse repo rate is used to control money supply. Repo rate involves sale of securities which could be repurchased in the future. So if the banks wants to borrow from RBI, they have to keep securities when they are doing it through repo rate. However, in reverse repo rate, there is no securities involved, only transfer of money from one account to another. So how easy is that for banks to earn money? Through reverse repo rate. But this is rarest of the rare case where RBI uses reverse repo rate as an instrument of monetary policy. So I'm sure you have liked this video, you have understood the basic concept behind reverse repo rate, which will certainly help you to gain knowledge on this banking concept. Please subscribe to my channel and also share it on social media. Thank you. Have a great day. Bye-bye. If you like my video, please like, share, comment and subscribe to my channel by pressing the bell icon.